of Sala 24/7. My name is Niharika Walia Bhatnagar, and I am with you with the era of ABFM. Hello, everyone. I hope you're doing well, and at the same time, you have been preparing well for your examination. We have time. Earlier, our examination was supposed to start in. Our examination normally starts in the. It started a little earlier last year. Though, if I talk about the reality, things are changing a lot since the syllabus changed this year. We have the problem related to the area of elections being clashed in the JIB area. So there were changes in the JIB examination recently as well, but our examination is way after. So I think we are good to go. Our examinations will start in July, and then we have June, July area for our exam. And everyone. Acha, with this, I am done with all these things individually already. I hope you remember that part. We are done with all these classes individually. Individual chapters are all sorted, but now I'll be talking about the blend of multiple chapters. So this is basically a blend of multiple chapters that we are taking up. I have also discussed many of the chapters as well, individually as well as mixed chapters, entire modules as well. So let's look at it, everyone. How do we pursue further? We are looking at the victory series. In the victory series, what's the first thing? Acha, this is related to the area of tax-free reorganizations. Acha, what does the step transaction theory aim to prevent a tax-free reorganization? It aims to prevent acquirers from assuming the liability for target company debts. It aims to prevent the target shareholders from receiving excessive compensation. It aims to prevent transactions that resembles sales from quality as the tax-free reorganizations, or it aims to prevent target companies from retaining the control over the business operations. Its basic work is basically to prevent the transactions that resembles the sales from qualifying as tax-free organizations. See, sometimes you are making sales and you are making good money. But what if this money is taxable and you are putting into reorganizations? So they make sure that this doesn't happen. Na? Done, everyone? Chaliye. The answer is C. They try to prevent the transactions which are actually not taxable. They want that only the not taxable areas should be removed. The ones which are taxable should not be included. Done. Chaliye. Moving on to the next point. In US, what is the period for net operating losses that can be carried forward or backward? Is it 10 years and 10 years forward, 5 years backward, 20 years forward, 2 years backward? And then we have there 15 years forward, 3 years backward, or forward for 5 years and backward for 10 years. What's going to be the answer, everyone? In terms of US, you can extend it up to maximum 20 years forward and 2 years backward. In our country, we cannot have backward losses in terms of this. They can be carried forward for maximum 8 years. But the depreciation can be continued. है ना? चलिए. What conditions must be satisfied for the capital gains arising from the transfer of the assets to be exempt from tax and amalgamation? The amalgamated company must be a foreign company. The scheme of amalgamation must satisfy the section 47(5). The scheme of amalgamation must satisfy the section 2 subsection 1 subsection B, and the scheme of amalgamation must be approved by RBI. If you really want exemptions, there's only one point. That was 2 subsection 1B. Done, everyone? चलिए, what is the significance of amalgamated company? What do you mean by amalgamation, everyone? Normally 1 plus 1 is equal to 2, है ना? Normally we say that 1 plus 1 is equal to 2. What if in an organization, if one has positives, second one has positives, and this becomes more than 2? Because both of their positivities have to be added there. Then it becomes more than that. What is the significance of the amalgamated company being a company for tax relief purposes? है ना? So what do we do in this case, everyone? What's going to be the answer? It ensures the it ensures the compliance with foreign tax laws. It facilitates the transfer of assets across the borders. It allows easier regulatory approval, or it is requirement of the exemption from capital gains tax. Amalgamated company and Indian company. See, in case of amalgamation, when two companies amalgamate, it is covered under Section 47. If one company has shares and it gives shares to other company, then this is movement of shares. Nobody is getting money and nobody is spending money. If nobody is getting money, nobody is spending money. Then I think in this case, there's one particular thing which is absolutely clear. There is no tax. It is requirement for the exemption from capital gains. Chaliye, let's look at the next question. In case of transfer of shares, everyone, we're talking about the transfer of shares. When a transfer of shares by shareholder of an amalgamated company not regarded as a transfer of for capital gain purposes. When the transfer is made in consideration of cash payment. When the transfer is made in consideration for allotment shares in the amalgamated company, when the amalgamated company is a foreign company, or when the transfer is made without any consideration. What's going to be the answer? Amalgamated company not regarded as a transfer under capital gain. When the transfer is made, if you have cash payment, it becomes taxable. It is an amalgamation is covered here, which this means that the companies are merging together, but there's one particular thing which is clear. That with this clarity, the amalgamation involves a payment of cash, which is taxable there. So the first point is definitely true. When the transfer of is made under consideration of allotment in amalgamated company. When the amalgamation is with the foreign company, it is considered here. When the transfer is not made without any consideration, I think if we talk about shares now, if you have shares, you give shares. When the movement is totally on the basis of shares, it's based upon only one thing. When the transfer is made in terms of allotment, shares versus shares, there's no movement. है ना? चलिए. Done, everyone? Under Section 47, Subsection 7 of Income Tax Act, what are the capital gains arising from the transfer of the shares by shareholders of amalgamated company exempt from tax. When the transfer is made in consideration of the cash payment, when the transfer is made in consideration of allotment of shares of the amalgamated company, when the amalgamated company is a foreign company, or when the transfer is made without any consideration. What's going to be the answer? Even though it's a transaction but not stated as a taxable one. When will this happen, everyone? What's going to be the answer? In this case, what's going to be the answer? The answer is when the transfer is made in consideration of allotment of shares in the amalgamated company. See, amalgamating and amalgamated. The company which is converted into some other company is to be considered here. A new company is being bought. So when one company is converted into another company, that is to be considered in this case. An old company is now a new company altogether. So when we are trying to have this kind of situation, this is where the organization is looking at what? They're trying to expand. When you're looking forward towards expansion, you are amalgamating with another company. You want the growth, so by looking forward towards the growth, you are amalgamating companies. The companies which will become one later on. And the company that is being formed is called amalgamated company. That is the difference between these areas. We have amalgamating and amalgamated. This is what is trying the process, and this is the ultimate reach. The rule says in terms of direct tax, on this one particular beautiful point. That is, if you enjoy the money, you pay tax. If you don't enjoy the money, why to charge money from you? That is to be covered in this area. Okay? Done. Chali. Now let's look at the next point. What conditions must be fulfilled for a company to take advantage of the carry forward of accumulated losses and unabsorbed depreciation under Section 72A of the Income Tax Act, everyone? But there are certain rules. If one company is facing losses, it can continue. It can try to make the losses a little better. The losses can be recovered. We have to make sure that we are recovering the losses altogether. And how do we recover the losses? If it belonged to the previous organization, they will continue with the new organization. This will ensure that the new organization is also getting money. It is also getting the benefit of all the losses which the previous organization genuinely faced. So in this case, there is one particular thing which they clearly say, that when we are talking about the organizations altogether, then every organization is looking forward towards growth, and that is why if they have to amalgamate or join hands with other organizations, they will do it duly. So in this case, when they do this part, then the amalgamated company should be a foreign company. It should be engaged in the business. It should be an Indian company, or it should not be a public sector company. It has to be only one thing, an Indian company. A past Indian company can give its losses and depreciation to the new Indian company. This is allowed. If the past Indian company is not there, then new Indian company cannot get the funds. So we need to have two Indian companies which are amalgamating. ठीक है ना? That is something we cover. How long must the amalgamated company hold at least 3/4 of the book value of the fixed assets? 3 years, 4 years, 5 years, or 6 years? If you are an older company, now it becomes a new company. New company has to hold all the assets and liabilities of the previous company for a certain period of time, that to 75%, also called 3/4. In the law, it is written 75% of the previous company's assets and liabilities has to be taken over by the new company. And not only they have to take over, but they also have to keep it in their hands. Okay? Done, everyone? The answer is 5 years. Chaliye. Let's look at the next question. What is the consequence if the specified conditions for amalgamation are not fulfilled? Amalgamation is cancelled. Amalgamated company receives tax benefits. Business loss and unabsorbed depreciation are treated as income, or amalgamated company receives government funding. The consequence of specified conditions for amalgamation are not fulfilled. When the amalgamation is not fulfilled, there's only one problem. That is business loss and unabsorbed depreciation are treated as income. These things which could have been carried forward, which the company could claim ki the previous company faced losses and the present can also utilize it to set off. This utilization will not be allowed. That's the worst part, that even if it was justified, even if this was the reason that you amalgamated two companies because one of them was excessive losses, so that's to be covered. Done. चलिए. चलिए. What is the rate at which income tax is levied under MAT if the amount of income tax payable under the general provisions of ITA is less than 15% of book profits? It is 10% or 10%, 15%, then is 20%, or the last is 25%. In this case, the answer is 15%. Chaliye, then this is it for the day, everyone. I hope this session was helpful for you. If it was, then please let me know. चलिए, and here comes our website, everyone. If you're looking forward towards our courses, then what you need to do is check out our website. That is www.adda247.com. Just need Adda247 to go to. You just went on to Adda247. Then once you go to the area of www.adda247.com, go on to the area of JIB and CAIIB.